think we've got a quorum here. We got 20 participants. That's a good number. And I will start out here. Let me share a screen. Billy. Oh, ACES is Billy. Okay, cool.
Okay, I'm going to stop my video.
All right. Okay. So let me stop my video here. I'm going to share a screen. And it's this one. And so what I have is a little agenda here in the corner, and it just shows I was going to go through a portfolio update. That was the portfolio that we came up with last meeting. And then this past week, I was doing usually certain trading style, but last week I was a little scared about the triple witching. So I ended up doing basically trading futures. And I figured, well, okay, I'll make a trading or a hedging presentation as well, so that people can get an idea of what different ways of hedging. And then we'll have some open discussion, and then we'll follow that up with what to do on Monday, look at the excess profits calendar, and some more discussion. And if we have some time, I have a thing I've created which is called a strategy defense map. I'm doing that for every strategy I produce. I always have a way of defending it. So whenever I go into a trade, I always know how I'm going to be getting out of the trade. If I don't ahead of time, I get screwed. So that's what the optional one is, if we have time at the end. So let me go and take a look. We'll take a look at the trading based on this portfolio. So we came up. Let's see here. So last meeting we came up with a portfolio, and these were the various people that contributed, and these were the various stocks, and you see the ones that are highlighted here. Apple, Amazon, Google, and Tesla. Did I put Tesla? Yeah, I did. Okay. And so those were the four that really came out of the whole thing, out of the whole meeting. And then, so how did they do? How did those things perform? So I built a little indicator trade station, and that is, let me hide this here. Hide virtual, hide floating mean control. Okay, so this is, so we basically came up with the four big ones are going to be Apple, Amazon, Tesla, Google, and then I put together a portfolio of these, and I said, well, how did they do? So the last meeting here is this vertical line, and if you would have bought, you take, I think I said, I think I used $100,000 here. Yeah, so I used $100,000. I said, if you put $100,000, split it between each of these four stocks, you would be up about $7,600 since the last meeting. Not bad. 7%, 7.5% in a month. That's not a bad deal. If you would have added one more, which is, I'm going to try this here. Let me try something here. The sound. So I'm going to try something. See if this works. So during the meeting, somebody came up with another idea. I don't know if you remember this. Can you guys hear?
Try BX. Bravo X-ray. Blackstone.
Ah.
Got a nice little pullback. I bought some this week.
Blackstone.
Hold it. Yeah, Blackstone.
Ah, so it's got a stochastic hit there too. That's kind of a nice thing to do. All right.
They're basically what Goldman Sachs used to be before they became a bank. So they're just very aggressive in the private equity space, real estate. They just kind of just taking over everything, it seems like.
Huh. Okay. I'm putting that one on my list. That's a good one. Cool. All right. So that was just a little refresher from the previous meeting. And so if you would use those same the same stocks that I had here, and then you would just have added the Blackstone that Scott mentioned. So this is the Blackstone edition here in the black. You would have, instead of having $7,000, you would be up $10,200 on that on the past month's move. I thought that was pretty cool. So I didn't know. I wanted to test it out to see if that all worked, if the audio worked, video and audio worked on that. Did that work for everybody or not?
Yes, it worked for me.
Okay.
All right, it worked.
Okay, cool. All right, good. So I don't know if anybody else took any of those trades. I have been doing other things along the way, so I didn't do that. I need to basically build my portfolio. I'm waiting for stochastic hits in the various stocks. And for me, I'm waiting for Apple to come down and then it start turning up. And I'm waiting for Amazon to come down a little bit and turn up. But the only one that would have hit was been the Blackstone, and that would have been a stellar move. So thank you, Scott, for that one. Hedging. So this typically what I have been doing recently is doing what's called a BBIC, Bill Burmeister's Iron Condor. And if you would have been doing it all along, you would have, netted out, net between 40-50% per week kind of number, or 20 to 50% per week. And once in a while you have a loss. This one here was a loss, a mistake and a loss. So the Iron Condor is the green is the long call above. The red is the short call of the Iron Condor, and then the red below is the short put, and then the green one is the long put. And so what the idea is, if the price goes right down the center, you collect all the premium, you're done. And I've been collecting somewhere between 45% and 52% of the spread for the last 3 months. And sometimes it works out, and like you see here, sometimes it doesn't work out. This week, because of all the cautionary comments from our previous meetings, I decided to stay out of the trade. Not my best decision, but if you would have gone into the Iron Condor here, it basically went right down the center of the channel, except for Friday. So you would have lost just a little bit on the Iron Condor, but it would have been not a 52% was what the initial return on capital was, but at the end it would have probably dropped to 40%. So that's not a bad deal for 40% return per week on a stock that's basically going sideways. I kind of like that, but like I said, I didn't do that. I ended up trading futures. And this gives you an idea of some of the automation I put in place on the futures. And so I basically look at the first minute of the day, first few minutes of the day, and I either go in, I go long, I go short. I don't know which way the market's going, and especially in these times. So this strategy that I use, it's also available on my website. If you go to ken.xs profits, you can download it. It's called Trade About Price Point, I think it is. So you're basically trading about a price point. If it goes above it, you go long. If it goes below it, you go short. And so you couple a couple of those together, and you basically say if it goes above this point up here, the highest of the day, it goes long. If it goes below the low of the first few minutes, you go short. And so what this thing did is, I'll show you a close up. So this thing went short, and then it came back up and it said, oh, it's going up again. So it gets out again. And then it comes along and it says, oh, I'm going to go short again. So go short. And then it ended up staying short through the rest of the day. So it can do that pretty quickly. And usually, let's see if it did here. It basically didn't make any money, didn't lose any money. So on the first trade, if it's a little red bar below it, it says it lost money. If it's a green bar above it, it says it made money. This particular one, it just basically broke even. So the first trade of the week, it didn't make anything, but I could do this all day. I don't care which way it goes. And if I don't lose any money on a trade, like, that's a good deal. But then at the end of the day, so I said, basically at the end of the day, I said, just get out, because I don't know what's going to happen overnight, and I didn't want to bother. And I made some profit, so I said, okay, I got a little profit here. These are the E-mini, the micro minis. And then you take a look, and so the next day comes along, and I do the same thing again here. And this one went short again. So it's like, okay, it goes short, doing the same kind of gyrations here, right? So I'd hate to have to do this by hand, but it goes short, and it says, oh, it's going back up. Okay, get out. Oh, it's going short. Oh, go back up. And so here, the last one, it says, okay, go short, and it stays in the short through the rest of the day. And so you can see these little marks on the bottom here. So these little marks show 14% a $15 loss, basically, and a $5 loss. But then through the day, it makes a $350 gain here. $350 gain. So I like that. You only lose $20 to gain 400, 300 or 400.
And what was the original capital?
What's that?
What was the original capital?
So the original capital on that is for 2 contracts, that turns out to be about $4,000.
So 10% in one day.
Yeah. Mm-hmm. Yeah. But that's futures, right? So, so instead of doing the iron condor, I was doing this, as well as I was trying to figure out how to do the hedging, because I look at the seasonal calendars, and it says, oh man, you're going to get ready for something to fall here, and then Scott came in and he said, hey, this is triple witching week this week, or quadruple witching week this week. So all sorts of contracts end on on Thursday. So it's like, okay, I am going to just stay clear. Last time I was in the market, I got creamed on the quadruple witching. It gapped, and this time it wouldn't have gapped at all, so it would have been fine. But so anyway, so this is another day, and then we follow on to find the next day. And here, this day, it decided to try to go. I'll show you the beginning of the day here. So here it says, okay, go short. Oh, okay, okay. It tried to go short. It turned around and it says, nope, it's going long again. So it turned around the next time. So I lost $10. And then it goes above and it says, okay, go long. So it goes long and it goes long again. It gets out. This would have made a little money, but it waits till it gets back down there. It didn't make any money, didn't lose any money. It does this again a couple of times, and then it ends up through that day and it goes long. So it ends up staying long. So basically, if you put a price point in after our first few minutes of the day, and just decide whether you're going to go long or short. And this particular day, it was going short and it was going long, and it ended up making 600. How much did it make here? What should it make? It should show here. Why didn't I show that? It looks like it's about $750 in a day. So I lost about $15 and I made about $750. So that kind of trading, I can do that all day. As long as the market was whipsawing, that's great. I don't care. It just can't whipsaw a big bar. These are 1 minute bars. It can't whipsaw 1 minute bars. If it goes, if the price changes by $500 in that 1 minute, I'm toast. But typically, it doesn't do that. And I got it set up to do a limit of about 8 trades in a day. And here it is again. So it's going long, short, and it eventually goes a bunch of times, and it finally just says, that's it. You're done. You're not going to get out. You just get out of it. And so this day, I think it was actually 8 trades in a day. And so I lost, let's see, I lost $90, I guess, in a day. So that wasn't too bad. And then the next day comes along, and last day, Friday, came along. It's the same kind of thing. You're going up, down, up, down, up, down. It's nice when you can get a breakout. If you could actually set it up so there's a breakout, it only has to do 1 trade, and it takes the trade, and you never see it. You never have to look back again. So you end up with a really nice return on your loss. Your profit factor is way high, very, very high. So here's another one. So that's what I was doing this week instead of doing the Iron Condor. So it ended up, I made some money on it, which is good, but I would really like to get back to the numbers of the Iron Condors are making 20 to 50% per week. Those are much superior, but you run some risk, and you've got to be agile in your trading. So, and you can't use your whole net worth. This one here, with the trading, even in the futures, it's difficult to run full all your capital in there. So it's still a small amount of money. But then I said, well, this is kind of nice, but what about hedging? What about hedging strategies? So I'm concerned that the market is going to fall. And if the market falls, like it did here in November, in 2020, the market fell 33% for the COVID. And so if you would have, this is SPY. So if you would have stayed in SPY, you would have been down on your entire portfolio. You would have been down, or if you had a portfolio that is comparable to SPY, you would have been down 33% in just over a month. That's a significant hit to me. With TradeStation and with the optimizations I do with my stochastic, I don't ever see that kind of pullback, which is nice. But I'm trying to build, like we talked about last time, I'm trying to build a portfolio that's a long-lasting portfolio. So I'd like to have something that I could basically put money into the market and not have to pull it out. I have a couple of retail accounts, and then of course I have some Roth IRA. So the Roth IRA, I can trade it in and out, no problem at all. But the long-term accounts, the retail accounts, I get taxed on. And with all of the taxing coming down from the current administration, it really has me concerned. So I said, well, what can I do to mitigate any kind of fall, a dramatic fall like this here in the marketplace? So I'd like to be able to put into holding position, get something that I can hold and get long-term capital gains, but I don't want my my net worth to drop as precipitously as a 30% in a month. So if you instead use the E-mini, this is the at ES, and you would, this indicator here basically hedges, allows you to hedge. So you basically say, okay, your portfolio is SPY, and then you're going to use the E-mini as a hedge. E-mini requires only, I forgot now. It uses a much smaller amount of capital to put on a hedge than it would be if you had your entire, if you had $100,000 in SPY, you'd only have to have less than $10,000 in your futures account, and you could basically mitigate this loss, this drop. So here is an example where it basically you add these two things together. So you have a retail account that is falling, but then you have a futures account, which is you basically sell short here on the futures, and you perfectly match the loss to the fall of SPY to the short position in the futures. And what ends up happening is that your P&L goes perfectly sideways. So this bottom chart, so this shows the 30% gain over this period of time. This is the 33% loss. So it's actually from the bottom to the top is almost 60%. So if you would use the E-mini to mitigate that, your net worth ends up going up about 56, 57%. So I kind of like that. Yeah, your one account is getting hit, but you're still in it long term, so you're going to pay long-term capital gains. Does anybody else do this other than the big hedge funds? Anybody in the group do this kind of thing? Or
well, this is Nick again.
yeah, Nick.
I'm kind of doing the same thing because I have like a long-term SPY.
Yeah.
And then I'm using the E-minis to just do like small trades. So all my gains are on futures basically, and my long positions are the spiders. I don't pay any capital gains or anything like that.
Right.
But I mean, so but in your case, you said when you hedged and you bought the whole, so you even out you didn't lose, you were getting even. Does this assume you keep the E-mini negative on the 56%? It assumes you kept the E-mini through the whole run.
No,
or you got it.
So it's just between these two bars here. So this is when you go into the hedge. So this is just a hedging strategy, right? So you go in the hedge from here to here, and then you basically mitigate the loss and basically flatten out your net worth portfolio.
Ken, and this is Rolf. How do you know when to go short?
Exactly my question too.
So what I do, Ralph, I use this K-stochastic, and so it always pulls me out when it starts turning over. I actually can I get out all the time, right? So this thing has been very, very reliable. I understand that you did some code that also does the same kind of thing, and the code that your strategy does the same thing. It basically gets you out when it's falling. You're out, right? This was Rolf's strategy.
Yeah.
I don't know, but you're basically what you've done is you're basically out here too, right? So this was the big fall in 2020, and so if you just use that signal to sell and go long or short the futures, you're going to be in Fat City. So you're actually going to even do better than if you would have held it all the way through, because you're actually selling that. But you could actually use this signal to actually, if you have a long portfolio, if you have SPY, so this is SPXL. So if you have a long portfolio and it says sell, you have a long portfolio as well as trading SPXL, you could use that sell signal to actually trigger the buy or the sell short for the futures. Does that make sense?
Right, but it's not, I mean, this strategy did get a sell signal, but not all strategy may be so fortuitous to find the sell point or the buy point for the E-mini or the short going short with the E-mini.
Yeah.
So it may be difficult to hedge unless you exactly have a strategy that catches that.
Hi, Ken.
Yeah.
This is Jack.
Yeah, Jack.
What's more concerning to me, don't minimize it because I'm going to ask you something. What's concerning to me, yes, this is great that it protects you from that big downfall, but if you look at the analyzer report What I'm concerned about is all those little losses that you'll be incurring along the way.
Do,
Because you're basically, selling lower, buying higher.
selling low, buying high.
Aren't you doing that?
No.
Oh, this is SPXL. But how is your futures side of it?
So so use the sell signal here to basically flag you either via an alert or something like that. It says, hey, this thing is automatically sold, and it says, okay, something big is happening in the market. COVID is coming down, right? Okay,
Mhm.
I'm going to go and sell short. I want to hold all of my positions. I don't want to actually hold you don't want to hold SPXL. But if you have a SPY position and you do the same kind of strategy, use that to basically say short the E-mini.
Right. No, I get that part. My question is, you see where it says buy 72.24 on the screen? 72.24. Right after the big dip.
Yeah.
Is find 72.24. Go up two more. Next one,
Yeah.
yeah, 72.24.
Yeah.
There, you see there's a sell signal. Okay.
Right.
There's a sell signal right after 78.29, and then a buy signal
Right.
at a higher price.
Right.
So that's a loss trade.
Right.
And what I found is with any kind of a hedging strategy, you will be incurring a lot of losses along the way when the drop is not that big.
Right. Yeah. So I'm saying it has to have something that's external to this, that you're basically making an additional assessment. Hey, this COVID, because there was nothing big. This is just a simple market correction here, right?
Right.
But this other one was a big one. This one here was COVID scaring and all that kind of stuff. So if you look back and you look at the previous big drawdowns, there is a lot of angst in the market, and so when those things happen and you realize this, that hey, I've got this large position, I got my net worth in SPY or the market. I don't want to I don't want to sell it all out, but instead, what I'll do is I will just go in. I know how many contracts I need to do,
Right.
and I will put on those E-mini contracts to mitigate any loss. And yeah, you got to be.
Yeah, but Ken, that's the easy part.
Yeah.
The difficult part is when you got the sell signal, you didn't know that there's going to be such a big down move. So you got to take those sell signals in case they're causing a big down move, because you don't know how far you're going to go.
Well,
So,
if you see an exogenous event, 9/11 or COVID or something of that ilk, or the Federal Reserve or the federal money supply melting down or something, it's a pretty big event. There's only a few of them like that, right? That doesn't happen very often. And you wouldn't want to do it necessarily for these short pullbacks, right?
well, yeah, but my argument is, how do you know at the beginning of the pullback, how do you know if it's a small pullback or if it's going to be a big pullback? We don't.
Okay, let me show you. I'll open up another workspace here. Okay, SPY analysis. I think you can pretty much guess that they're ahead of time when something major is afoot. So if you go to YouTube, you'll find this graphic that I did, and I couldn't figure out how to scroll it. This has got many years on it, and so I made a YouTube video, and it shows this was a pretty good size sell off here. This is the U.S. debt thing happening. We knew ahead of time that all of this stuff was coming to be. So you're like, okay, we got the debt vote. that's going to be a big issue. That's something that's coming up. If you look at the other events here, a lot of these other jobs recovery disappointing. Yeah, that's a little one. 9/11. I didn't go back as far as 9/11, but 9/11 and the previous two, the 9/11 was a pretty big one, and
Yeah.
then let's see, China. So it's going to be an exogenous. It's going to be a evaluation of the exogenous events, right? And if you don't feel comfortable doing that, here's the coronavirus. So if you don't feel comfortable doing that, yeah, just stick to trading it, and that's what I do in my IRA. I'm in and out of these things. I'm not in and out as much as those strategies I showed you previously, which was Ralph's strategy. But
What are the colored lines?
the colored lines are you an electrical engineer?
Yeah,
Okay, so you remember the color code,
yeah,
the resistor color code?
yeah,
Well,
yeah,
those are color code.
For what though?
So it's 3 is orange,
Oh, I see.
5 is green,
Yeah, yeah.
purple is yellow,
Got it.
violet, and then white is 10,
Okay.
9. So yeah, so these are just percentage drops in the market.
Okay.
Yeah, you can go and take a look at the YouTube video and you can see
Mhm.
more detail. And then you can stop it, back it up, and that kind of stuff.
Right. Okay. Thank you.
Okay. All right. So going back to the hedge. So we talked about hedging using the futures. That was the futures. And then people talk about putting on a collar. Hopefully people on this know what a collar is. Let me see here. Let me throw this back. So a collar is basically selling a call, that's the green, and buying a put. So typically you want to put on a collar and you would like to actually make money. If you're going through some sort of a putting something on, doing something, everybody should want to get paid for it, right? So if you get paid 6 cents a share, that's what this thing does. But if you look at where the market is right now compared to where it could go down for the put, you have 1% upside potential. So you can go back up if you're worried that the market's going to sell off. You got a 1% upside potential if it goes up, and then you have a 10% downside potential. So it could actually drop on down to something below that. The key though is that as long as you maintain the collar, roll it, or just use it as a separate entity, you can mitigate your potential losses. So if the market sells off to not down to this 415, if it goes down to 420, for example, you will have some additional value on your put. Then you have to make a decision of, do I sell the put and think it's going to go back up, or what? Therein lies the crux. If I use the case stochastic, I have pretty good confidence that if it goes back up, if the stochastic comes down here and it goes back up, I would basically pull that put back in, sell it off, and ride it on up again. But this thing, you have it requires less capital, but this is basically covering your current position. So your current position could be taken away if the market continues on up. If it gaps up for some reason, I always said that it never happened on SPY, but there are some events here. This one here, this was pretty significant gap up here. It generally doesn't do that on something as big as the S&P 500. But that's one possibility. Another one is to just buy put protection. And people typically go back and look at the previous support, which is somewhere around 435, and they would just basically buy a put on their long SPY positions. And the problem there is that it's going to cost you $4.25 per share, and that's going to decay over time. This is for an October expiration. So it's going to decay. If it stays there or goes up, you're going to lose money on that. So this is an insurance policy, people talk about it as. You have unlimited upside potential, but you have a 3% downside on it. Jack, how do you do? Do you ever use any of these other strategies for hedging, or do you use hedging at all?
Yeah, I'm looking at a different strategy, which is buying a long-term leap deep in the money, because that thing acts like a stock, and then selling calls, short calls against it at a much higher strike price.
Okay, so don't even own the whole portfolio. Don't even own the stock per se, but use leaps instead.
Sure, it's much more efficient.
Yeah.
Well, you can do that with stocks too. It's just not as capital efficient. Like, for example, if you have you invested in SPY,
Yeah.
assume that's like a leap and you're going to hold it for, multiple years, right?
Yeah.
You don't have any theta decay if you hold the stock.
Right.
But if you buy deep in the money leaps, depending on the volatility of the, when you buy it and how the underlying volatility is, and SPY is not very volatile, you have very little theta decay. So you can, like I have a position in Apple, I have $100 calls deep in the money, right? And they're pretty much acting like a stock. So, and that's a year and a half away, and I'm selling, 45-day, 160, 165 calls against it, and keep on doing it. Rinse and repeat, rinse and repeat. So that's like a cycle, and I can probably recover 50 to 75% of the cost of the leap by the time the leap expires. And I think Apple's going to be over $100 in a year and a half.
Yeah. Okay. So when you sell, you said you're selling a 160 or 165 call?
On Apple, yeah.
So are you getting, what kind of premium are you getting on that in terms of
Not
percentage?
not a whole lot. I'll have to check. Like
'cause
around a dollar.
$100?
$1.45.
Okay, so 1.41, basically 1%. So you're basically getting 1%.
Right. And if something happens, I can always roll it. And even if I decide not to roll it, by the time you do that when the stock goes down, so now is probably a good time. You buy the long lead, and then let's say you're buying it at, what is it? Apple is it 149?
146.
146, right. So that's about the time when I bought it. Last time it was around here. And, at 160, you have a really nice profit on your lead. Okay.
Yeah.
So, I mean, even if you get called on it, you're still making pretty good money.
Okay. Yeah, every time I tried to do that, I never made very much money on the calls. Either that or you'd come on down. So you're at 160, so you're above the high. That's okay. If you would have sold that call up at 158 or so, that would be great. But if you're selling it now, that would not be a good thing to do.
Well, now you buy the lead. When Apple goes up, you sell the calls.
Got it. Okay. All right. So you're basically actively trading it. So what the original premise was that you wanted to stay in a position and mitigate losses by either trading options or futures to basically level out your net worth. But what you're doing is you're basically saying, okay, Apple's going to be going all over the map, and you're gonna trade it. So if it does go up, you're going to have to trade the call, roll the call up and out.
Mhm.
Or if it goes down, you're going to be okay if you pay $100 for it, even if it goes down to 90.
Yeah, well, those are not cheap. Those are expensive. It's probably about $5,000 a leap.
Yeah.
But whatever you lose, you're making up more than that. If you buy it right, you're doing more than that with the profits on the shortfalls.
Got it.
And
When you're done with this topic, Ken, I did have a question back on your futures page, but just when it's appropriate for you.
Yeah, sure. No, good. Oh, the futures trade. Yes. Yeah.
Yeah, that one that you were talking about earlier.
Uh-huh.
I wanted to understand, I just wanted to make sure I understood. You created an automated strategy here, and
Uh-huh.
sometimes you overrode it with manual decisions. Is that correct?
The only overriding I do is for sometimes I will take a profit. If I see it going down really, really quick, I just say, okay, I'm going to take a profit because I know I'm going to be going out. Yesterday at 10:30 in the morning, I had to go and deal with an acoustics guy, right?
Oh,
so I have to
understand.
override it for that because I don't want to basically have this running when I'm not somewhere nearby.
Oh, exactly right. No, I agree. So I understand that option, and have you had good success and no issues intermingling automation with manual overrides in terms of the trade station, trade manager interactions?
No. So it took me a while to understand how to override it, because if you override, say you come into a position and you have I'm short
Yeah,
the
right, like
E-mini
that,
here,
right
right?
there. Uh-huh.
And then I say, okay, I also have a matrix here, right? I have
Right,
I have a
right,
matrix, and I say, okay, I'm just going to put in a stop here. I'm going to put in a
right.
stop position. I just
Yes,
say, okay, I'm going to put a stop at this point. I click on that, but then what I end up having to do is I go over and I disable the strategy, and then I just move the stop on, by hand manually.
oh, okay, so have you ever taken a manual trade and left the strategy going? In
Yeah,
other words,
but then what happens is that if the strategy doesn't see the same position as what it thinks it has, so
right,
say you're down, you say you want to take off one of the contracts, right? So
yeah, yeah,
if you have a strategy that says, okay, I went short 2 contracts, and you want to get rid of one of them, right? So this thing went here short 2 contracts, I think, or long 2 contracts. I can't remember. Yeah, so it's going long. It went long 2 contracts, and I take off one of them. If I take off one of them using the matrix,
right.
then the strategy just says, I don't know what the heck's going on, and it just says, I can't deal with it. So it produces a little warning window that comes up and says, hey, there's something that isn't right here, or there is another option in the strategy. This may be getting way too technical here for people. In the automation thing, there's a thing that says strategy.
Oh, adopt the real world position.
Yeah, adopt the real world
Yeah.
position. Yeah, so you can actually have it adopt the real world position. So there's a couple of different handles that they put on it. It requires a little more sophistication. But I typically just try to keep it as simple as possible, and I'll put a stop in. I see this here. This is here is resistance here. So I'll put a stop in here. I'll just say, okay, I'm in a trade. I'm in a short trade. Okay, I'm going to put a stop in here, and then walk away. And as long as I put a stop in, disable the strategy, I feel comfortable with it. I'll go walk away and I'll go for a walk or something like that.
Right. And just one other philosophical question about strategies in your opinion, or trading concepts. When you hear different discretionary traders and some of the pundits and such, they tend to talk about the signals that they use and keeping those parameters over time and just making money over time without any optimization. So the question is really, do you believe in the optimization or the stability of like one of the famous ones is like Jake Bernstein's 10-8 moving average channel,
Yeah.
for an example.
Uh-huh.
He's talked about that forever. I have
Right.
no idea whether he's really making money with it or not. I don't have any questions about that, but what about,
He does.
does he? Okay. So would you optimize a 10-8 moving average channel strategy over time, or would you just keep it at 10-8 and make money? Or what's your opinion about optimization versus fixed principles?
Well, so the market does change over time. There are different characteristics.
Yeah.
And for example, there is this thing. Let's see here. I call the Jenkins Cycle. So the Jenkins Cycle is pretty good at figuring out when it's going down. It says, okay, you got so much volume, and the market's going to go flat or turn, right? And I use that pretty regularly. However, over time, there is a difference in the market. This thing here is optimized for 620 million shares. And it used to be 1 million shares. But I've been doing this for about 20 years. It used to be 1 million shares. And over time, it's sort of gradually moved. It's because of the dynamics in the market and the way some of the people are trading it. For something like that, I had to change it over time. But for this other one that's running my IRA,
Right.
this is basically running my IRA. It uses the K stochastic. It used to always be 13 bars all the time. And over about 3 years ago, it changed to optimize to about 10 bars. So typically it doesn't change very often. And like I said, this has been trading my IRA for more than 10 years now, and it's got a pretty good expectancy on it. But it doesn't happen very often. So yeah, it's got a profit factor of 100, 83% probability of success, that kind of stuff. So, but
Wow, that's amazing.
well, the thing is though that it doesn't happen very often, right? So it only happens a few times, 4 to 5 times a year.
Mhm.
But when it happens, and then when it happens across SPXL, TQQQ, and TNA all at the same time, I go 100% in on those.
How do
I
you
take
read it again?
What's that?
How do you read K stochastic again? How do you read the indicator when you say, when you
When
get
it
the
crosses, the stochastic crosses here,
Oh.
you got this vertical line here. It said buy.
Yeah. Oh, that's the buy. Okay.
Yeah. And then on the Excess Profits website, it talks about the stochastic, and I did that, 8-10 years ago.
Mm-hmm.
It talks about how to exit and stuff. But yeah,
Okay.
but that seems to be the best of them all. But like I said, if you don't want something, if you want something that you don't have to trade very often, that's the best I've found yet. I haven't seen anybody that comes close to that, and it usually makes about in the past it's made about 30% per year, and now it's somewhere around 100%. Yeah, just close to 100% the last few years. But yeah, so you don't trade very often there.
Mhm.
So yeah, there is optimization, Neil, but it's over a long period of time. Steve Alexander tends to do keep an eye on the market a little bit, and he will change some of his characteristics a little bit more frequently than that. But typically, he leaves it pretty much alone. If Steve is on the call here, Steve Alexander, chime in. Correct me if I'm wrong, Steve. I don't see Steve there. But yeah, and he actually sends out his trades, emails his trades to people, whether he's going go buy this and then sell it, whatever. But yeah, he's up. I think he's still up over 100% this past year. But yeah, so there's different optimizations. Neil, do you do optimization on your stuff?
Yes, and I generally agree with everything you said. It's just so interesting that almost any pundit you hear over the years, whether it's Jake or Barry Burns or anybody, they tend to yeah, Bigelow's 8 moving average, ADMA. All of them seem to always talk without variance about certain fixed numbers. And of course, Fibonacci numbers are popular and all that. So I just wanted to get a take from others as to whether that's reality or not. And JB, I think, just mentioned Jake makes money on his 10-8, and that's been around for 30 years. And yet no alteration in that channel, for example.
Yeah, but so if you are either lazy or you figure that this is enough money for me, or I don't know what other reasons.
That's a good point. I like that, and I agree with it. Actually, I mean, I agree with it. That's why you do periodic optimizations. Exactly the same reason you said.
If you're not lazy, lazy and willing to take a bit of a hit once in a while. So I was optimizing and changing things regularly, but then it would be going good, and then it get hit, right? I get slammed. And so when it doesn't, because I wasn't back testing far enough. But if you have something that's fundamentally works, if you go to my website, ken.excessprofits.com, there's one called the Holy Grail. It always works. It works on anything, any time frame. But is it the best trading strategy? You'll always make profit. That's the goal of it. But will you make the best amount of profit? Well, the best I have seen so far is this K stochastic. If somebody's got a better one, let me know. But I haven't seen anything that comes out with a better.
And what was it you called this? The what stochastic?
K stochastic.
Yours.
My version.
Yours.
Ken's the version.
No, I just didn't hear the K.
The K, yeah. I know. I have the same problem. K is a plosive.
Yeah,
so
yeah.
You can't hear it. Yeah. So kilo. Right? Kilo stochastic.
Thank you.
Yeah. And it's also on my website, Ken.Excess Profits, and it's available both for TradeStation as well as for the Thinkorswim platform.
Great. TradeStation is all you had to say.
Yeah. All right. All right. Any other? I do have an option.
I'll chime in just to say this was a great session today, Ken, and
right.
You always do such an excellent job, and I appreciate the comments from others as well.
All right, good. Good to hear. That's always good to hear. All right, great. I like I said in the beginning, is I always try to come up with a way of getting out of a trade. Whenever I enter a trade, I'm always trying to know, okay, what are the ways to get out of it? One of the problems that I had we had some training before with the Investools, and that's how this whole thing came about. And that's why I keep on saying it's an Investools users group meeting, and that's where it sort of started. Well, what they didn't do is they never told you exactly how to get out of a trade, especially for an option trade. And so what I have been developing over time, before I get there, is you can call it an exit envelope, or you can call it a defense map. This was a presentation from October of 2020. And if you go back even further in the Excess Profits website, you'll see that I gave a presentation even further back than that. But this was sort of like the updated version. And so this is basically you're saying you're going to enter a trade. So you enter a trade here, and there's various conditions. So when do you exit the trade? So I said, okay, I'm going to enter the trade because it's a breakout. Okay, this is a little breakout here above this line. So I said, okay, I'm going to enter the trade. Well, when am I going to exit the trade? Well, one possibility is if the thing goes shooting on up, all right, I've got an upper sell limit. This thing just says it's gone up really, really far. I'm going to take my profits and run, right? So that's what this one is here. This is saying, okay, it just gapped way the hell up here. I'm taking my money. There is one that Larry Williams talks about, which is a weight zone. He says if it stays in this certain zone here, and he says, well, how do you determine the zone and stuff? So it's different for every stock, right? On my price point trading on the thing I was showing before, I basically have it goes above a certain point, I go long. It goes below a certain point, I go short, and so I have various criteria. But when you go in and you're buying a stock, I want to basically, I don't want to touch it. I'll let it go as long as it stays within a certain region. It doesn't go crazy. I'll stay in the trade. If, however, it goes out, if it starts going down here below the previous support, I just say, I'm out of there. This doesn't make any sense. My expectation is that it was going to go up, and it didn't do that. So all of this black area here is basically, okay, I'm going to stay in the trade. But these red areas are where I'm going to actually exit my trade. So I do this on every stock. So when I enter a stock, I'm also putting in my stop. I usually put in now, I also put in an upper limit too. I say, so if I get into a trade, I put in my stop loss, and I say, if it goes up to here, take my profits, I'm out of there. And then over time, what I'll do is I'll go in and I'll massage it. I'll vary that. With the automation at TradeStation, it basically does this automatically. So it basically, when you see this thing go up, this thing goes from a support down here, it goes up to here, it goes up to here, and then it goes up to here. So if it ever drops below that, it automatically gets out. So I don't even have to think about it. As long as I can encapsulate my thinking process into software, I do that as much as possible. And it's been working pretty well for me. And if you listen to Brian Cox, he does the same kind of thing. I was going to try to put together all these different defense maps, if you will, or exit envelopes for different people. Everybody's got a little different style. And as I was doing this, I said, maybe I can refine this even more. So I would go and I said, okay, I also have this thing called, which you can also get from Ken.Excess Profits, is a thing called, it's based on but this basically just says underneath it, it just basically just has a slope plot is what it's called. But anyway, so it basically just says if it's going up at a certain slope, stay in the trade. So it becomes more finer grain. So this was the way I was doing it before, which is steps. And now I basically have a finer grain. It says that if it just keeps on following this curve up, stay in the trade. Anyway, so that's the simple thing for stocks. But then we went to Investools, and we said, okay, well, what about verticals, vertical options, stock options? What about diagonals? All these different things. Well, the one that I have glommed onto most recently is this one with iron condor. So this is this price action. You see here the price action. This green line here is a call. So this is an iron condor, and this is going to be an iron condor, right? So don't worry about that. I can't. This is a preliminary thing. I was trying to draw the whole thing up, so it's a lot more busy than it needs to be. But and I was going to try to step through this, but just give you an idea of what my thinking is here. So the iron condor is basically these green lines are the long call, long put. The red lines here are the short call and the short put. So you basically have this iron condor. If it goes down the center, that's where you get the maximum amount of profit. So there's a region here in the center where as long as it stays in this region, you basically stay in the trade, don't touch it. Now, if it goes above, if it starts, remember I showed you on the previous one, if it starts shooting up, the price action starts shooting up real quickly, well, there you have to deal with it differently. So we had this thing called the Bill Burmeister's Iron Condor, which was a defense for the iron condor. And I have used it many, many times where you get into a trade, all of a sudden the market starts taking off. And if it takes off within, this is days. So this is 30-minute bars, I think it is, or 15-minute bars. And so this is a day, this is another day here, this is another day. So this is a week. So this is Friday. So every day, so for the first day, if I get into a trade the first day and it goes into this region up here, I immediately say, okay, I'm going to basically buy back the short call and let the long call run, right? And I let it run through there, and then I make my profit by exercising, or not exercising, but selling the long call. If it goes below this point, I basically buy back the short put and I let the long put run and hopefully make money. The idea is that if it's running really quick, if we have a trend, if we have a very fast trend, the trend is your friend, and it should keep on going. It's the same thing if the trend starts moving in during the week. If it starts following a trend and it breaks through this short put position, I basically buy that back and I let the long put make the profit. And then, so over time, this is becoming pretty effective. When you put on this on SPY, you're collecting about 45 to 50% the return on capital margin per week, which is pretty damn good. But then if you get into this region, so if the price action just sort of meanders out here, it starts getting up into here, then what you say, okay, it's not necessarily going to go through this point, then you do what's called a butterfly defense. And let me show you what a butterfly defense looks like graphically. So I hope I've got it here. Oh, I don't have it here. Hold on one second here. Here we go. So this was actually a butterfly defense here. So this was an iron condor put on, let's see here. Drawing tool, annotate. So this was a iron condor this was iron condor put on early in the week. This is Friday, this is highlighted in yellow. So I put on an iron condor, and then what happened is that the price action started falling, and I said, uh-oh, if I could only just move these two strikes down, the short put and the long put. And so what I ended up doing is the structure to put that on in one fell swoop on options trading is a butterfly. You buy this back, you sell two of those. You sell first one, you basically sell this one then you have to sell another one to make it short, and then you have another one which is a long put at the end. So this is basically a butterfly defense. So a base of the effect is to extend the distance on the short side of the iron condor. And then what happens is that over the period of the week, you end up with it's still in the range. This would have actually been a loss. You started out with a 51% initial potential gain, and you end up with a 20% return on capital after you execute the butterfly. So 20% in a week, I'll take it. So that's the butterfly defense there. And then the next one is you basically stay in the trade. Well, some of us, like Bill Burmeister, will stay in the trade all the way to the end. He wants to get every little last penny out of it. I'm trying to figure out exactly when you want to get out of a trade. If you are in this area here, you want to take your profit and run, just get out of the trade, just to prevent it from going out too far out here. If you are just before the end of the day, I end up executing basically get the position back, just basically close out the entire position. So if it's in this range here, I'll just close out the position just so that at the end of the day, it doesn't go whipsawing up or down and, risking risking 10 cents or risking thousands of dollars to make a few pennies, a few cents. Doesn't make sense to me. And then the next one is what happens in the iron condor if you're going along, everything's fine, and then all of a sudden one day it gaps up. If it gaps up, I just basically just do nothing and take the loss. That's a losing day. So this basically, to me, this kind of a chart basically outlines every possible scenario that can happen through the week. I have all of my exits in place at the start of the week when I put on the trade, as opposed to what we had in the Investools stuff. They just showed you how to put on the iron condor, and it says, yeah, if it goes down the center, you make money. Okay, but what happens in the meantime? Is there any way to defend it and stuff? So these are just different ways of defending an iron condor. What I'd like to see is ways of doing this for every option trade, verticals, diagonals, puts, short puts, short calls. See what other people are, how they would actually define their defense map. Does this make sense to people or not? Or is this too messy of a chart?
No, it makes sense.
Okay. Jack, does it make sense or not?
Yeah.
Okay. All right. And that you even got the optional presentation here. Okay. Anybody else got anything?
You always keep my interest up on the case stochastics, and I think you mentioned there was a presentation. Couldn't find it, and I looked at my notes. I've had to-do lists that have to-do lists, and somewhere in there it says review Ken's presentation. Do you know where it is?
Let's see here. This is the
Oh, okay.
website, and so the first one was done in 2015, and look for stochastic here. Fine. Okay, and so that's the indicator, and there's the code, and experiences trading the case stochastic.
That doesn't explain how to use it.
Yeah, well, all right, so let me go back. So there should be another one in here. Experiences. So this is Tim Sawyer's. And I don't know whose presentation that was. I don't remember that. I can send it to you. It is already, should be something like everything you wanted to know or something like that on the.
Right, right.
So I'll send it. I'll send it to you here.
Okay. Thank you. I didn't mean to distract you. You always speak so highly of it, and I have tremendous respect for you. So I
Yeah,
figure it's something I need to know about.
yeah. It seems to be working exceedingly well for long periods of time, and it's based on really fundamental stuff. So there's nothing major.
Mhm.
Yeah. But anyway, let me just check one more thing here. Price action. No. All right. I'll have to send it to you, Jack.
Okay, thank you. I appreciate that.
I can't pull it up.
It's all right.
I don't remember exactly where it was now. I thought it was pretty straightforward, but I guess it isn't. I guess it isn't. It isn't called the case stochastic there. Oh, so this one is done by Joe Zhao, which is pretty good. All right, I will find out the original one that I put up there. But anyway, you guys.
One
go
thing,
ahead.
yeah, one thing I've been using in options trading is Tushar's premium momentum. And it's actually pretty cool because it tells you when the premiums are rich and when they're not. So it allows you to have, when the premiums are rich, you're selling credit. So I'd be looking at a put or a call vertical, credit vertical. And when the premiums are poor, yeah, you can do a debit vertical if you wanted to, but probably best to do a diagonal because then you get theta working for you too. And that's been actually affecting my investment strategies, my trading strategies. I could be seeing some kind of a directional move on a chart. Then how do I implement it with options? That's my go-to, trying to figure out, do I want a credit or a debit strategy? And that's been working very nicely.
Okay. So you basically doing the stuff that Tushar was talking about last meeting?
Yeah.
Okay.
Yeah.
Okay. Now, are you using? So let's see here. I've got. So this is the FTM.
Yeah. No, IVT.
IBT. Okay. All right.
V is in Victor.
Got it. IBT. All right. I haven't been using that one, but I was trying to use his. Let me share something here real quick. I was using his FTM, his simple FTM here,
Mm-hmm.
and let's see here, and I compared it to the stochastic, and I still prefer the stochastic myself. I ended up, because it says a couple of times I was using this FTM, and it missed some opportunities that the stochastic just took into stride.
Yeah. Well, Ed, that's not how you use FTM, with all due respect.
You don't?
FTM is not an indicator that gives you signals that you can pull. So when you get an FTM signal, you're supposed to be looking at the market profile. to
Okay.
see if there are any references, any support or resistance above or below before you get into it. And then you also have to look, how's momentum doing? Are you in momentum squeeze, or is the momentum expanding? Only after that you make the decision, but you can't use FTM on its own.
Yeah. So
Trust me, I tried, it doesn't work.
with the case stochastic, use it on its own. That's all you need right there.
Okay, when do you buy it? When it's
Right there.
green?
The green is when you buy.
And red is when you sell?
That's the adaptive moving average, but these are the entries here.
Oh, it doesn't have exits?
The case stochastic strategy on the whole, if you have the TradeStation case stochastic, you'll actually get the exits as well. All right, yeah. So it uses the adaptive moving average to get you out.
Mhm.
So if it crosses the adaptive moving average, you set a say enable exit, and then when it drops, if it drops below the low of the day that it crossed the adaptive moving average, that's when you get out. You put a stop just below that, and that's what it's doing.
Okay,
So that's it. All right.
yeah, thank you.
Mm-hmm.
One of the easy exits is you just exit when it takes out the previous swing low.
When it crosses when?
When price takes out a previous swing low. You know what I mean with swing low, right?
Yeah. So I'm just looking at this particular chart here, and
Yeah, look at all the swing lows.
well, here's a swing low here. There's a swing low here. It would have triggered there, and this
It
one
would have
here,
triggered.
this
yeah.
one here would have triggered low here.
So
Or actually, I can put on Larry Williams' thing I coded up also on my website is a circle bar here.
I have a toss indicator. I haven't done it for TradeStation, but
So this one does that.
okay.
But
5 bars below, before 2 bars after is what I use.
so there's different levels of hierarchy.
Okay.
And so here is a previous swing low. So you can see the yellow lines, and it would have gotten you out here.
Yeah.
Instead of getting out there with the adaptive moving average.
Okay.
And well, the adaptive moving average is way the hell up here, so it actually got you out, and here's a swing low here, way down here. So
right.
I can set it up to try and use either way for exiting, and so like Neil, like we were talking earlier, I can optimize it and find out what works and what doesn't work. And the previous swing lows, I was never able to get as good of a return on capital as the adaptive moving average.
You know what, Ken? It always boils down to this with exit strategies. Do you want to stay longer in the trade, but that means you take bigger risks, or do you want to protect your profits, but that means you'll be exiting early and leaving money on the table?
Yeah. So it depends on what. So well, the key is that what I like about TradeStation is I can go back and I can explore those, right? So I can go back and I can see, well, is it the swing lows better than the adaptive moving average, better than the moving average, better than Jake's thing?
Right.
You know, so I can try all of the possible combinations, and so I have 10 years ago. This is my gold standard here, right? And my question to anybody is, can you beat it?
Right. Well,
and I only had one guy that beat it, Ed Stefan, and he modified it and for the futures, and he blew the socks off of the one that I did just the month before. So he was the only one that came up with better. He basically started with the stochastic, but he ended up changing some of the parameters. And it
Right.
worked really, really well for like 3 years at least.
Do you have any arguments to adopt the moving average
What's
that you
that?
modified?
No, it's the standard. It's just the
Standard.
standard, the same ones that are being used in TradeStation, the defaults, as well as in the TradeStation.
Okay.
I
It's
tried to
interesting.
optimize those too, and it didn't seem to matter.
Right. Two of my favorite exit strategies are, as I said, the swing low penetration. And the other one is, if I want tighter profits, is the lowest low of the last 2 bars. That gets you out a lot sooner, but much more profitable trades. That means you need a good reentry strategy if you get taken out.
Right. Yeah. And so one of the things that I did is I tried to remember that the one that I was showing the trade about a price point, for example. And so what I did is I paired that. I basically just said, okay, you throw any strategy at it, and then what we'll do is we're going to go and make a note. When you exit a trade, and it's going short, for example, right? So if it's exit this trade, if there's something up here that caused it to exit the trade, then just say, okay, that's going to be the point where I'm going to trade about that point. And so I actually created a strategy to try to utilize that and say, okay, here's my reentry. So it notes, okay, I had 5 contracts, or I had 2,000 shares or whatever. When I exited, okay, that exit price is going to be the point that I'm going to trade about. And I haven't been able to figure out a good way. Every time I've tried that, it invariably didn't work out with a positive expectancy. So if you got something better, Jack, let me know. I'd love to hear it.
I'll tell you, probably the best I know to look at. It's not an automated thing, but I do market profile. Usually
do what?
using TP market profile, using I don't know what the equivalent indicators are on TradeStation, but on TOS it'll be TPO. You can use market either volume profile or market profile. And I would do a 3-month profile, and it will show me where the big areas of congestion were. And typically the price will either stall there, whether it's above or below, or the price will bounce there. And I've not seen anything better than that.
Okay. All right. Yeah. See if I can enter that study here. And called TT something, right?
No, TPO, a time price opportunity. See if you have it. TPO profile, you got it. Top one. Okay. And let's no, don't plot it yet. Let's see what it's showing. Can we look at the details? Make the grow height to 0.5. You're doing across the chart?
Yeah, because it's a 3-month chart.
Okay, that's fine. That'll work. But do it at 30-minute chart. Actually, this will work fine too. Okay, for all intents and purposes. Okay, we're looking at SPX.
Yeah.
Guess what? Around 4407 or 4420, right? That's where there's going to be a lot of support. You see how those big green bar, the biggest green bar is there. Also the red one, that's the POC, which is basically the fairest price, where everybody agreed where the price was. So, 4407, that's where price is going to stall or bounce up, or even if it gets there. Where we stop is at the lower bound of the next go up, where there's the next set of longest green bars. Yeah, right there, just to the bottom of it. You see, we came there. We we call what we did look below and fail. So it just went dipped down a little bit and came back up and closed right up there. Surprising? No. Okay, so these kinds of things just happen. So
Yeah, they happen, but what I found doing this is to trade about that point, or to use that as a hard exit or a hard entry or a re-entry, the hysteresis is immense.
And the time frame is subjective.
Yeah,
time frame,
30-minute
why
bars.
don't you think the
20-minute
time
bars.
frame is subjective? I mean, if you have a 3-month chart, even if you do 30-minute bars, you're still going to get something similar.
That's your point, isn't it? I mean, you're going to use a 3-month bar or a 6-month bar. And if it's in and if the stock happens to be going sideways, you're going to have a much narrower arc. See? I mean, it's just where it spends time.
Correct.
I mean, that's just an accident.
Yeah,
It's a mathematical, I don't want to say aberration, but it's just, it doesn't tell you what it's going to be doing.
well, nothing tells you what it's going to be doing,
Yeah.
sure. So,
But I don't see how it helps.
well, then I suggest you study it some more because I've been using it for years.
Well, show us your trades that are based on that.
I'm sorry, what?
Show us your trades
It's not,
and strategy that are based on it.
okay, it is not based, okay. These are not systemic trades that require some intuition in understanding it, okay? Here's the thing, when you look at something where the price spent a lot of time, that means buyers and sellers have agreed on the price, right? So that means there's a lot of value in there. There are a lot of buyers there. There are a lot of people who are going to sell if they start losing money.
Well, using the chart that's on the screen now, you see the prices in the lower part of the chart. Now, history tells you it's going to go back up.
No. You're not interpreting it correctly. First of all, you're looking at a 10-day chart. How can you make references to longer term decisions just based on a 10-day chart?
You can't.
That's the point. So we need to look at 3 months or 6 months. That's my point. Okay. Now you're seeing a different picture. But the point is that the areas where we spent a lot of time trading are still there. If you look at it like 6 months or a year, maybe the fairest price will change because we've just been going up and up and up and up. But there are still significant support and resistance areas where the buyers and sellers were in equilibrium, where the price spent a lot of time at, or a lot of volume at. Okay, so those are the points where price will either slow down or bounce. Now,
They were considered fair prices in the past.
yes.
Okay.
But you
yes.
think those buyers and sellers
No.
are still going to be there?
I mean,
The
okay.
buyers are going to be there, right? So the price is up now. So you're saying that there's still a lot of buyers down in that range.
No, what I'm saying is, isn't it surprising that last 2 days price action or the one from 3 days ago stopped exactly where there was a reference point. We call them as reference points.
So you're
And
saying
I
that
see-
this point here is a reference point here.
Yeah, it's a reference point. There's another one below that. There's another reference point. So, the thing is, we're just letting the market let us know where it felt pretty strong about the value of the price. Okay,
Okay, now, I mean, you would think the support points where the price is reversed and started going up again would be considered either out on the extreme of the, we're assuming this is
No, no, no.
supposed to be a curve, a
Excuse me.
standard distribution, right?
Excuse me, you are just bringing in a whole lot more stuff into it that doesn't belong there.
Okay,
So let me tell you, that's a mistake I made a long time ago. This is maybe a little more difficult or different to understand. So one thing is, we never know what the market is going to do. So if you're thinking about, oh, I'm just going to be bouncing off of 2 standard deviations because statistically that's significant, I'll show you a bunch of stocks that blew the 2 standard deviation, kept on going up as well. So I don't think there are really a whole lot of absolutes. And I tell you, as a system trader, a strategy trader, there's nothing I wish that there were just pure absolutes that I would subscribe to. But what I'm noticing is there are telltale signs in the market, and this is one of those. It doesn't mean that the price will bounce there. That doesn't mean the price will reverse there. But all I've noticed is there's a good possibility that it may, and even if it doesn't bounce, you're gonna incur a slowdown there. Okay, so we can use it, especially as options traders. We can actually use that. You see, it's hitting a reference point, and it's really not going through. Okay, it may not go through. I'm just going to take my profit at that point. You may do that with stocks as well. You may do that with targeting, either on the upside or on the downside. Okay? And the whole point is, it's not like, hey, I'm just going to get off exactly when it gets there. It is, I'm going to watch what the price is doing when it gets there. Chances are pretty good that it's going to slow down or reverse, but I want the evidence of that before I pull the trigger. Just getting an extra piece of information, you're not getting a decision maker. You still need to make your own decisions. Does that make sense?
So you're using it as a qualifier, not as a trigger.
Correct.
Hey, Jack, if you look at those histograms which are extended on the right,
Which is where I'm looking at, yeah.
That's what you're looking at. And then, so if you just put like a support lines on some of those,
Yeah.
and you would say that, okay, this is where I would expect it to be supported before it starts moving up, right? At that point, yes, that's exactly what I think Jack is talking about.
Right. You look at those longest bars, and then you put a line there at the bottom of it.
Below that, the one
No,
which
just a little above. That's where the red line is right now.
right.
You already have a red line there.
Okay.
You want the dollar line, I think. The top right.
Yep.
And then maybe looking at now the case stochastic as well in combination of that, if case stochastic also kind of weakens up, or I think start showing some signs, maybe
Okay.
you can combine it.
Yeah.
Ken, you mentioned about the adaptive moving average that you use in TradeStation. I also see that on Thinkorswim. Did you try to see if it's the same or similar, or is it different?
Identical.
It is identical. It's just is it adaptive EMA or just the adaptive moving average?
I didn't know there were 2 different ones.
I see 2 different ones in Thinkorswim.
Oh. I only remember one.
If you just type in ADAP, ADAP adaptive EMA, and there is, if you go down, there's a moving average adaptive. Starts with MO, yeah. So there are two.
So the adaptive EMA is going to be a exponential moving average.
Right.
And so this is probably the one. I have never seen that one before. I always
Okay.
use the moving average adaptive, I believe.
Do you do any further setting than what it is? The
No.
standard
So
setting?
the default are typically all that's needed.
Okay.
I can't remember who did that, who set that up, but the defaults, every time I've tried to deviate off the defaults, it didn't enhance any execution. Let's see here. Oh, I did have it there. Okay, so it is already there. Okay. Yep, I believe those are the standard numbers, everything 230, 10. I think you find that on TradeStation as well as on Thinkorswim.
So far, I've been using mostly like the high of the low bar or low of the high bar basically to come out of the long position.
Okay.
I mean, but I guess that's me probably too quick. I'm just learning a couple of new things.
Yeah. So in this one here, so you basically say, okay, did the low cross the adaptive moving average? And this one here, so here's a low that crossed the adaptive moving average. This is the adaptive moving average. Here's the low. So I basically take the low of that bar and I say that's going to be my stop. If it goes below that, I'm going to exit. And so you're basically, here's where your new stop is. So you're basically moving up your stop up as it crosses the adaptive moving average, right?
So is that like the 4 hour?
No, just any. It doesn't matter whichever chart you want to use. It's independent of chart. Actually, I use it only on the day chart.
Got it. So you wait for that bar to close before you actually decide on that.
Yeah. So that's the enable for the exit, right? So.
But you don't take intraday, right? I mean, if it just dips below.
Right. So here it dipped below, right?
Yeah.
And then did it go below this? So this is going to be my stop. My stop is basically placed at that point. So when it drops below that, there's going to be my stop right there.
Got it.
And then this one, the next day, of course, it reverts on up. So you stay in the trade. Beautiful. Absolutely stunning.
Yeah.
It works. It works amazingly well.
So it works very well for like medium long-term swing trading, basically, not for day trading, I guess.
I've used it on both, but like I said, my gold standard has always been the daily. I mean, it depends on what your trading style is, right?
Like if you're doing a day trading, what kind of time frames would you use?
It depends on how agile you are. If you are, some people will go really, really intense. They'll be like there every minute, right? So the stuff that I do on TradeStation here, this stuff here, I've seen people do this day trading, right? I mean, that's what this is. This is purely day trading. So they're looking 1 minute and they got to be there the next minute, right? So they basically get out the next minute and then they get back in and then they get back out. And then finally, so you don't lose much money when you do that. You know, you're losing only just a few bucks. And then when you finally does make a decision as to which way to go, then you're actually in the trade and you're with that city then. So what kind of day trading do you do, Cal?
I mean, I don't. I mean, I honestly, if I can, I have full-time jobs. I'm just starting to kind of get back into trading after quite some time. So I just have like being in the Pacific Coast, we have like an hour and a half, 2 hours in the morning. So from 6 to 8:15 or so, I have to kind of quit by that time. So I'm looking for opportunities or kind of ideas around that. That was my other question.
So what time of morning do you start work?
I mean, I usually they expect even earlier, but the thing is, I've been saying 8:15. I would be ready for the normal day job.
Okay,
Uh,
so here's the simple strategy here. Basically, you're going in and what are you trading on, a trade station or Thinkorswim or what?
Thinkorswim, yeah. I mean,
Okay, so Thinkorswim.
yeah.
So you could actually do this on Thinkorswim. You could basically set up a price point and say, okay, I'm going to go on minute bars. I'm going to go long. I'm going to go short, depending upon the first 10 minutes here. If it goes above this high, I'm going to go long. If it goes below this low, I'm going to go short. And you could sit there and just do that for the first few minutes. By 7 o'clock, you're going to be in a position of either long or short. And then you put your stop in there and you go to work. And then whatever happens through the day, that's what you make.
So what is this? I mean, I sorry, maybe I joined a little late, but which indicator is this one? Or
This is a on TradeStation. It's a trading of about a price point. So you basically look at the first part of the day. This red line here is where the open is. So this is the open of the day.
Okay.
And you look back some number of bars, you say, okay, I'm going to wait for 5 or 10 minutes or 1 minute or whatever you think, right? And you say, okay, if it goes above this high point, I'm going to go long. If it goes below this low point, I'm going to go short. And you basically just watch it on 1 minute bars, and you're saying, okay, you could put basically you know what a buy stop is and a sell stop?
Yeah.
Yeah. So you put a buy stop up one tick above this high and a sell stop 1 tick below this low. And then you're going to basically just watch it. When that triggers, you want to basically be in there and you're going to say, okay, if it goes below that, I'm going to go short. If it goes above the high, I'm going to go long. And you basically watch it for the first few minutes, and every minute you're going to make another evaluation. Is it above that point or is it below that point? And you're either going to go, for me, I usually either go short or I go flat. And if it goes above this, I'll go long or I'll go flat. So I'll have this band in here, which is my, let's see if I can throw a box in here, rectangle. So this is going to be my high point and my low point. There's going to be a box, and it says if it goes above this point, I'm going to go long. If it goes below this, I'm going to go short. And so you can see it just started going short.
10 minutes.
What's that?
Is that your first 10 minutes?
So everybody's got a little different. So some
Okay.
days I do it on a minute. I know the market is really volatile, and I'll wait 1 minute and I'll see what happens in the first minute. And I'll just say, okay, that first minute is all I'm going to look at. And so I'll go back to here and I'll say, okay, this is 1 minute or 2 minutes into it. And I'll say, if it goes above this, I'm going to go long. If it goes below this, I'm going to go short. And if you're doing this discretionary wise, you might be actually able to make $1 or so on each transaction. With the automation, I haven't figured out how to do that. I basically break even for like about 8 trades. I can basically break even. So sometimes it makes money, $1 or 2. Sometimes it loses money, $1 or 2. And so it basically goes flat, and that's what you see here. It's just basically going flat for all those trades that I did in there. But I'm doing automation. You're trying to do this by hand on Thinkorswim. And,
Okay.
and you should be able to get good execution. So if you have a matrix up or something like that, you should just be able to say buy at market, sell at market, because there's only 1 tick difference between the bid and ask usually on a future. Are you using futures or using the stock or what?
Yeah, so I mean, I can use futures. I haven't really, I mean, as I said, I mean, I just trying to get back into it. So I'm,
Okay, then just use a stock. Just use SPY.
yeah,
SPY is great. SPY is, you know, you even one share, buy $300 or $400 for a share and see if you can make money on that, and just practice on that. And
Right,
if you want to try that, and then if you can go 5-minute bars or whatever.
yeah,
Depends on how agile you feel you are and how much attention you want to pay to it. I can't pay that much attention. If it goes past 2 or 3 minutes, it's beyond my abilities. TradeStation, automation, it can sit there all day, look at that, and make sure that it always works.
that's excellent.
Okay.
Yeah.
Any other comments, questions? We got 10 minutes. So my question to everybody is, what do we do on Monday? So let me go to the Excess Profits website here. And look at the group calendar. And so we have this 7-day trade, which said Friday to basically short the market. This is a short trade entry. So it would say, hey, sometime during Friday, just sell the market. Just or if you are long the market, get out of the market, and then 7 days later, get back in. And you can see, I think, the detail. Yeah, so if you look at the more details, you'll see all the details about, should say all the details about what, about that trade. I don't see the details. Whoa. But this is a seasonal trade, and it happens every, in September, there is a thing called the quadruple witching, and that is when all sorts of contracts expire. And they expire, and notoriously, the week after that is a down week. So if you are an options trader, you may want to buy some puts or sell some vertical calls. I don't exactly know what everybody's style is, but everybody here has a different style. The next month is there's a thing called Go Away in May. I wrote a paper several years ago. If you go to it here, tinyurl.com/go away in May, you'll see all the research I did on it. And they traditionally, all the stockbrokers say, hey, you can't time the market. Well, this is basically saying, yeah, maybe. And this thing shows that over the course of the last 20 some years, you would return about a 20% return per year on this simple strategy where you basically go away in May, and it has, if you go in our calendar and look, you'll see exactly when to go away, the specific day. And this is the day when you would actually return, which is going to be the 9th of October, which is going to be before the next our next meeting. So if you are so inclined, you may want to get ready to put some capital to work there by the 9th of October, because between the 9th of October and May is traditionally a good upswing in the market. But again, for me, I end up looking at the K-stochastic if it comes down, and it's coming down right now. So when it sells to go long, I will go long, and I will let whatever happens. And then at the end of October, which will be after our meeting, there is a cat trade, which is so if you're this has been extremely profitable for me for the last 5 years, and so I end up buying calls on cat. And I think last year, I made, I can't remember, 50-60% on that in just between October 26th and November 6th. So just put that on your calendar and keep it in mind for a possibility for a trade. Is it going to work 100%? Nope, but it has some pretty good odds. So keep a tight stop on it, and if it turns on you, just get out. Any other comments, suggestions, ideas on what to do on Monday? And I am going to continue to do this futures trading here, this daily futures trading, because it still looks like we've got quite a bit of volatility in the market. And I can make some pretty good money through the day on that. And it doesn't matter whether the market's going up or down, although this is the after hours here, and this is the E-mini after hours, and you can see that it was still in sell-off mode. So if you would have sold on Friday anytime, you would have been up. nicely, or if you would have been out of the market on Friday, you would be thanking the excess profits calendar that you got out at the right time. Any other questions, comments? I will call the meeting to a close, and it's great to have you all aboard, and I hope that it works out well for you for the next month.
Thanks, Ken.
Yeah, Jen.
Oh, just saying thank you.
Okay, all right.
Yeah, you guys,
Thanks, Ken.
good trading, everybody.
Have a good trading, successful week.
Thanks very much, Ken.
All right, great.